Alright guys, welcome to part 2 of the day trading course for beginners. So obviously in the first video I covered a lot of different things, but it was very basic. What I'm going to do now is number 1, I'm going to be going over liquidity, which we covered in the first video, but I'm going to show you what it looks like on an actual chart. Number 2, I'm going to go over fair value gaps, what they look like on the low time frames, what they look like on the high time frames, and how I generally use them to day trade paired with liquidity. All of that will be the second part of the video. The first part of the video is going to be focused on what chart this is. So starting off, this is the ticker symbol that I constantly trade. This is known as NQ, and right now I am trading NQH 2025. Why is there an H next to it? Well, I explained to you guys that this is not like the normal stock market. This is a predictive market, and it essentially trades in quarters. So throughout the year, there are 4 different contracts that we will be trading. NQH is the March contract, so that is going to be traded from January to the end of March. NQM is the June contract. That is going to be traded from the beginning of April to the end of June. NQU is the September contract. That is going to be traded from the beginning of July to the end of September. And the NQZ is the December contract, which is traded from the beginning of October to the end of the year. And you can see for 2026, it refreshes. So we start with NQH 2026, then NQM, then NQU, then NQZ. And I make sure to change as the initial contract expires and the next contract rolls over. So that is the basics of what NQ is. Now, what does it correlate to in the stock market? If you are a trader and you know what QQQ is, the Invesco QQQ ETF that tracks a bunch of the top tech companies in the stock market, QQQ and NQ are correlated. So whatever QQQ does, NQ is doing. If you are a little bit newer to the stock market and you realize sometimes we will gap up or gap down in the markets, right? We close the day and then the next day we gap up. This gap that you see here is actually what happens in the futures market. So if the futures market, like I told you guys in the first video, it is open 23 hours a day. So the movement that we see in the futures market after the stock market closes is what we see in the results on QQQ. So if the NQ future starts to pump overnight, then you will see a gap up in the markets in QQQ. That is where these gaps come from. Now, you might be noticing the blue and the red box here. This is called the Asia and the London session. So there are 3 sessions in the market: the New York, the Asia, and the London. New York is what everybody is trading when the stock market is open. QQQ is moving freely while NQ is moving in the New York session. Then when the market closes, the Asia and the London session are what occur. And this is what I explained when I said that the futures market is open 23 hours a day. The Asia and the London session are what other people in other countries are trading while everybody in the United States is asleep. So I love TradingView. This is the software that I personally use to day trade, but you can get this indicator on TradingView absolutely free through the indicators tab, and it will automatically mark the London and the Asia session for you. You can customize this, and personally I have the Asia session labeled from 6 p.m. the day before all the way to midnight, and I have the London session starting at midnight all the way to 6 a.m. Now ICT, the guy that has taught ICT concepts, he is known as the father mentor of all of this stuff. His London and Asia sessions are a little bit different, but personally I don't just use ICT, and I have found that this labeling makes much more sense to me and helps keep things consistent. Now, the other ticker that I constantly am looking at but I do not trade is called ES. It works the same way as the NQ futures do. The contract rolls quarterly, so you can see that there's ESH, ESM, ESU, and ESZ. It works the same way every quarter. You roll the contract over as the initial one expires. You roll over to the next one every single quarter. Now, ES correlates to the S&P 500. So if you know the ticker symbol SPY, which tracks the top 500 companies in the US, SPY and ES are perfectly correlated, and it works the same way. When the stock market shuts down at the end of the New York session at 1 p.m. Pacific time and 4 p.m. Eastern time, the Asia and the London session begin, which you can see here. We have the Asia and the London session, then we have the New York session, Asia and London and New York, and on and on. Okay, so now that you guys understand what NQ and ES are, what the stock charts or futures charts actually represent, now I'm going to go over liquidity with you guys. So if you remember in my last video, we talked about liquidity. I drew a chart that kind of looked like this. I showed you mountain tops and mountain valleys and how the algorithms and big money use highs and lows in the market to create liquidity and reverse the market in the opposite direction. So you saw what these highs and lows look like with a very simple drawing that I showed here. But now I want to show you guys what these look like on the actual chart. So I'm going to delete the drawing and I'm going to start looking for areas in the chart with very obvious wicks. So for example, I'm going to label this low right here. As you can see, it is a low that forms in the market. I'm going to label this high, which you can see forms with this wick right here. Now, this is the 5-minute chart, but I'm telling you guys, this works on every single time frame. If I move into the 10-minute, the 15, the 30, the hourly, the 4-hour, the daily, every single time frame has its own highs and lows that form. And oftentimes the market makers or this big money or the algorithms are using these highs and lows to generate liquidity and reverse the markets to the opposite direction. So let's look at this high, for example, to start. You can see that we're trading back and forth, and then the market miraculously has this big green candle that goes above this high. Now, if I was to replay the market to this candle right here, obviously I showed you guys what happened. This is just looking back in the past on this chart. If you saw this happen and you were a regular retail trader and you saw this big green candle, a lot of people would think that this market is very bullish and that this is going to continue up and up and up and up. But in reality, like I said, this market is kind of like a casino, and the main goal is to trick people into buying assets for expensive prices and then reversing the market to make them lose money. So in this specific situation, most traders are taught to buy this candle with the expectation that we are going to go higher. But in reality, what actually ends up happening is that the market completely reverses. And as you can see, everyone that bought this asset right here, or bought NQ, had a complete reversal on their position, and they ended up losing all the money that they invested into this trade. So it ends up delivering all the way down to this low as well. So here is another example, guys. This is actually on the 15-minute chart. And again, I want you guys to try and label the high and the low that you see on this chart. So I'm going to let you guys pause the video right now. Give yourself a second to analyze what you see in the markets and label the highest high and the highest low, or the valley and the peak, kind of like I explained in the example with the drawing. If you guys guessed this high and this low, then you are correct. This is the highest high in this leg of price, and this is the lowest low. So as a trader, what I'm going to be looking for is for one of these to get swept, and I'm going to look to target the opposite way. So if this high gets swept first, I'm going to be looking for a reversal to the downside. If this low gets swept first, I'm going to be looking for a reversal to the upside. This is what big money and algorithms do. So our job is to try and see which one gets swept first and target the opposite one. So in this case, I'm going to move the market forward. And as you can see right here on this candle, this high was swept first. So if you are smart enough to realize what big money is probably going to do here, you will probably guess that we are going to go down to this low. All the books teach that once we break out of a swing high, that we're going to continue to go higher and make higher highs. But if you understand how big money works, you will realize again that we are probably going to reverse, induce traders to go long, build up liquidity, have people buy a bunch of shares or contracts or oranges for very expensive, and then sell the market off, forcing them to sell their oranges for dirt cheap and lose most of their money. And again, if we move the market forward, you will see that we completely reverse. Everybody that wanted to buy oranges for expensive is now going to be forced to sell their oranges at this low for a cheap price and lose a bunch of money. Okay guys, and let's do one more example here. I want you to label the highest and the lowest point on this chart as if there are mountains and valleys. I'm going to allow you to pause the video before I give you the answer. See if you can guess where is the highest high and the lowest low. All right, guys, if you guessed this high and this low, you were correct. And now, again, as traders, what are we looking for? We're looking for either the highest high or the lowest low to get swept, and then we are looking to target the opposite direction. So let's move the market forward and see which one gets swept first. By the way, this is the 1-minute chart, so every candle you're seeing here is 1 minute. I told you guys this works on every single time frame. It doesn't matter which one. The markets are fractal, so every single time frame behaves the exact same way. But as you can see, we just swept this high, the highest high of the day. So where can we expect the market to likely go if this high was swept? If you guessed this low, then once again, you are most likely correct. And if we move the market forward, you guys will see eventually, after some time, the market slowly trails down and ends up sweeping this low. Everybody who bought their contracts or shares or oranges up here for a very expensive price is forced to sell their shares or contracts or oranges for a cheaper price losing a lot of their investment. Okay guys, so obviously we have covered liquidity now. I showed you guys multiple examples of marking out the highest high and the lowest low in the market and realizing that when one of them is hit, this is a liquidity generating event. Lots of what I call dumb money buys up shares or contracts or oranges for a very expensive price, and the markets manipulate down and stop them out, forcing them to sell their shares or contracts or oranges for a very cheap price, in turn losing money. It's like as if you bought an orange for $10 up here and all of a sudden the orange markets collapse and you are forced to sell your oranges for only $7, meaning you get a $3 loss on your oranges. That is how I would explain it in the best and simplest way possible. Just because a high is hit does not necessarily mean that the market is going to reverse. Though these are very simple concepts and very simple examples, this doesn't always happen. There has to be a very specific set of patterns in the candlesticks below the liquidity sweep that kind of give me a hint that this is going to happen. So I explained to you guys that my model involves liquidity, but the second thing that it involves is something called a fair value gap. So what is a fair value gap? I'm going to rewind the market to this candle right here, and I'm going to show you guys why in a second. I'm going to zoom into this so you guys can see it. But a fair value gap essentially is fair value in the markets. What does that mean? In this specific situation, you can see this massive green candle right here. At this point in the markets, we pushed up very strongly, and there is this area in the middle of the candle where there are lots of unfilled orders, meaning the market moved up so fast that lots of people that wanted to buy shares or buy contracts or buy oranges did not get a chance to buy in this candle because it moved up so quickly. So what I like to mark on the chart is something I call a fair value gap, which is essentially the area in the middle of this candle that the market needs to eventually offer fair value. So how do I mark out this fair value gap? Well, it requires 3 candles. So I take the wick of the first candle and the wick of the third candle, and I draw a box between them. So this area that you see here labeled in purple is called a fair value gap. And I will label it for short as FVG. So if you ever see when I live day trade on YouTube, or if I live day trade in the Discord. Now, for those of you who are super new to the markets, I'm going to explain something super quickly. Every single candle that you're seeing here is basically price being printed in a physical form. And each candle has what we call the body and the wick. The body is the solid part of the candle, and the wick is the very thin part at the top and the bottom of the candles. So on a green candle, you have the high, the open, the low, and the close. There are 4 parts to a candle, right? Let's look at another example. This red candle right here with this big wick, we have the high, the low, and then the open and the close are going to be the top and the bottom of the body of the candle. So with a red candle, we're opening at the top and we close negative. So that's why it is a red body. And for example, if you look at this green candle right here, we have the high, the low, the open is the body of the candle, and the close is the top because we open here and we close positive, so it's a green candle. So now that you understand what a candlestick is, again, a fair value gap basically is an area of unfilled price between 3 candles. You mark the wick of the first candle and the wick of the third candle, draw it out as a box in time. That is a fair value gap. If the market is bullish, we want to see these fair value gaps be used as support to bring the market higher. Because basically what's happening is we need the market to trade back to fair value, fill all the orders that are waiting to be filled in this area, and then use that to drive the market higher. So in this specific example, you can see that we do end up trading into the fair value gap, and we use it as support to go higher in the markets. So here is another example, guys. I see one very obvious fair value gap in this leg of price. You can pause the video now before I draw it out, but let's see if you can guess where the fair value gap is in this leg of green candles. Okay guys, if you guessed this fair value gap right here, you are correct. This is an area of unfilled orders. Again, it takes 3 candles. So if you take this candle, and this candle, this is a very big green candle. It moved very quickly, and there are lots of unfilled orders in here. Lots of people that wanted to buy oranges for a cheap price that didn't get the chance to buy them. So in theory, the market needs to deliver to fair value, meaning we need to come back down into this area of price to balance the price, deliver fair value to the markets. And again, it is the wick, the top wick of the first candle, the bottom wick of the third candle, take a box, draw it out in time. That becomes your fair value gap. And in theory, the market needs to come back down to fill orders and create fair value in the markets before going higher. So if we move the market forward, you will see that, of course, we come back to the fair value gap, and you should see a bullish reaction from it to deliver the market higher. So now, guys, I'm going to combine liquidity with fair value gaps to show you how the market moves consistently. Don't worry, this is all going to come to fruition. I know it can be a little bit confusing, but again, I'm going to keep it as simple as I possibly can. This is an example that I showed you guys earlier. Again, I want you to mark the highest high and the lowest low that you see in the charts. If you labeled this low and this high, congratulations, you are correct. Now, earlier in the video, I did label this high right here, and I explained to you guys that when the market came up and swept this high, that we used it to reverse down to this low. But now I want to focus on what happens after this low is swept. And you can see here we are starting to reverse. And where do you think the market's probably going to go? If you guessed this high, you are very correct. So I'm going to show you how the market uses fair value gaps to deliver price up to this high. So I'm going to delete this high right here to stop confusing you. And I'm going to zoom into this area of price. So guys, I zoomed in. It's still on the 3-minute chart. This red line that you see right here is the low that came all the way from this leg right here that we labeled. And now I'm going to change this from the 3-minute chart to the 5-minute chart, just to make things a little bit more simple. Okay, perfect. So now that we are in this leg of price, I want you guys to find the most obvious fair value gap that I am most likely looking for, that I expect price to deliver from to go higher. So pause the video for a second, think to yourselves where the fair value gap is going to be, and I'm going to draw it out. So again, guys, perfect. If you guessed this fair value gap, you are correct. Again, it requires 3 candles, 1, 2, 3. Take the wick, the top wick of the first and the bottom wick of the third, create a box and draw it out in time. That becomes your fair value gap. And in theory, the market needs to deliver fair value. So all the unfilled orders here, all the people that wanted to buy oranges in this huge move up that didn't get a chance to, should be able to get their orders filled before we end up moving higher in the market, and in turn delivering to the next area of liquidity, which is this obvious high. And if we move the market forward, you will see that we do end up trading into it. And if I move the market forward, you will see that eventually we end up going all the way up to the liquidity labeled by this red line. Again, it's from this high, and slowly but surely you will see that it ends up happening. And just wait for it, and boom. So again, guys, this was the end of the market in the New York session. I explained to you guys in the futures market that there is an Asia and London session, and you can see that slowly but surely we end up delivering to the high that we saw from up here, all initially coming from the rebalance of fair value, trading into the fair value gap, and eventually going up to the next area of liquidity. So again, guys, consistent example of how the market uses fair value gaps, or fair value in the markets, which is basically support in the markets to go higher. So the concept I just taught you guys right now is the fair value gap to the upside. This is also known as a bullish fair value gap. If you didn't know, in the markets, bullish means that the market is going up, and there's also something called being bearish, where the market is going down. So just like there are bullish fair value gaps that we use as support to go higher, there are also bearish fair value gaps, which we actually use to go the opposite direction, meaning we're using them to go down. So I'm going to show you an example in this exact same leg of price using a bearish fair value gap to go downwards. So I'm going to delete this, and I'm going to go back to this high that we saw earlier. So if I replay the market to this big bullish candle, I explained to you guys earlier that this was kind of like a fake candle in inducing traders to buy their oranges for a very expensive price before dumping the markets down to the next low. So if you guys studied what I said earlier, and we showed this example before, once this high was swept, we are expecting the market to go down to the next area of liquidity, which in this case is this obvious wick low right here. So if I move the market forward, we want to see where the most obvious fair value gap is in this leg. So I'm going to pause the video right now. I've explained to you guys what a bullish fair value gap is. Now let's see if you can find the bearish fair value gap. I'm going to pause the video, see if you guys can find it. All right, guys, if you guessed this fair value gap right here, you are correct. Just like there are bullish fair value gaps. Now on the downside, we have the market moving down very quickly, and not a lot of people had a chance to fill their orders that were looking to short the market from this wick's low to this wick's high. Take a box, draw it out in time. This is the bearish fair value gap. And just like bullish fair value gaps are used as support to go up, bearish fair value gaps should be used as resistance to go down to an area of liquidity that the market makers and the algorithms and the big money are targeting. So if we are bearish on the market and we want to short the market and profit to the downside, we're looking for bearish fair value gaps to be used as resistance again to go down. And as you can see, we trade into this fair value gap on this green candle by just a few ticks, and we use it to go down to the sell side liquidity below, just like what you see right here. And here is another example, guys. I labeled the high and the low in the markets. Once again, we are looking for one of these to be swept, and then we are going to target the opposite direction. So in this case, you can see that we did sweep the high of this candle, creating a liquidity event in the markets. Now I'm going to move the market forward just a little bit because in this case, we do end up going higher, but I want to see if you guys can identify the bearish fair value gap that I want to use to go short in this specific situation. So go ahead and pause the video now, guys, and see if you can find the bearish fair value gap that we are going to use to target this low. And again, guys, if you guessed this fair value gap right here, you are correct. We swept the buy side liquidity, or the wick to the upside, and now we are looking for the market to reverse to the opposite area of liquidity. Remember, everybody who bought oranges for an expensive price up here are going to be forced to sell their oranges for a very cheap price down here because of how manipulated the markets are. So if we are bearish, we are expecting the market to trade into this fair value gap, use it as resistance to ultimately go down and take out this low right here. And if we move the market forward, you will see, guys, eventually we do tap into the fair value gap right here. And notice what happens as soon as we tap into it. We use it to eventually go down to the liquidity below, just like that. And actually we end up going much lower, but you can see here that we use the fair value gap as resistance in the market to go lower. Okay, guys, so that in the most simple sense is how liquidity and fair value gaps work to deliver price to where they need to go. The first video went over how liquidity worked with drawings. This video was focused on seeing liquidity on a real chart and how fair value gaps are used to deliver price to the upside or the downside using those fair value gaps. I'm going to stop there for this video to keep it as simple as possible. In next week's video, we are going to cover something called an inverse fair value gap, which is similar to a fair value gap, but it is used in a different way. And that specifically is my model that I use to trade every single day. So stick around until next Wednesday for that video. That is the real gem, and that is exactly how I use a model to make my money every week day trading. As always, guys, if you have any questions, you can always post a comment down below. I am happy to answer. You can also follow me on X and send me a DM there. You can follow me on Instagram and send me a DM, or you can actually join the Discord and you can send me a message there, add me as a friend. But until next time, guys, study the examples, see if you can find some examples yourself in previous times on the charts. I wish you guys the best of luck until next time.